Good afternoon and welcome everyone to this webinar hosted by Institutional Real Estate Incorporated and EPRA, the European Public Real Estate Association. And this webinar will be looking at European listed real estate market trends. Thank you everyone for taking your time out from your busy schedules to join us today. We really do hope that you find today's session valuable. I'm Marek Hansel, the editor of Institutional Real Estate Europe, and I will be moderating today's discussion. And we'll be covering a number of topics as we analyze the key factors influencing the European listed real estate market. As you'd expect, among them are topics such as interest rates, US tariffs, obviously, German fiscal policy, and we'll be looking at some sector insights, investor sentiment, and much more, hopefully. Our speakers today are Asiya and Adanush. I hope I pronounced that correctly, Asiya. Asiya is a member of the equity sales team at DGroof Petercam, and David Moreno, who is Indexes Manager at EPRA. Before we kick off, I'd just like to outline a couple of house rules, well, a few house rules. There's a chat function where you can ask questions, so please do ask questions as we go along. We will probably have a Q&A session towards the end of the webinar as well, but I may also interject and ask some of the questions you raise as we go along. If we don't have time to respond to the questions during the session, then please leave your name and we will get back to you with answers to your questions as soon as we can. We will be sending the slides from this webinar to all attendees, and this is being recorded so you can listen back at your leisure and send to colleagues and anybody else who you think may want to have a listen. This webinar lasts for 1 hour, and we will stop exactly on the hour. And yeah, so those are the notes I had to tell you all. So hello, Asiya. Hello, David. Thank you for being here today and for sharing your knowledge and insights with us all. It's great to have you.
Thank you for having us, and thank you for that introduction. Looking forward to the discussion.
Absolutely. It's a pleasure. So we're going to start with David, who is going to show us a few slides that look at performance and returns on the European listed market for 2024 and perhaps a little bit more. So over to you, David.
Yeah, thank you very much, Marek. Thank you, Asha, for joining us as well. And good afternoon, everyone. Let me quickly share the slides. It's going to be just a few slides, I think 4 of them, just to give a very broad idea of the general context for listed real estate in these first 4 months of the year. Okay, do you see the slides now?
Yeah, we do.
Okay, all right, perfect. Okay, let's start from here. All right, so I decided to start just with the 2024 corporate results season that basically took place during the first quarter of the year, where most of the companies release the end of the year results and the annual reports, just to start discussing what has happened after the end of the year and going onwards. So basically here is the summary of the results from the 58 companies that we were tracking here in this summary. Basically we had 50 that were aligned, basically neutral in terms of market expectations, and 50 were either neutral, positive, or outstanding results. So basically the main conclusion from the general results season was that most of the companies had quite positive year in 2024. It was mostly a recovery year after some strong headwinds in 2022 and 2023, basically as a result of the interest rates hikes that we saw during that time. Something interesting to see is how some of the sectors start showing positive valuations in terms of the property portfolios. Most of the companies continue having very strong operational metrics with a clear rental growth, The rental growth in general was between 2 and 6% for most of the companies, and the earnings per share also increased significantly. Generally speaking, most of the companies, the 50 companies that I was mentioning, basically most of them have results, earnings per share growing around 3 to 13% during the year, so quite good results. Only 8 companies have some results below expectations, but generally speaking, the results season was quite positive. And in terms of the sectors, well, the sectors also show some interesting results. So basically, retail, lodging and resorts, there was a lot of appetite at the beginning of the year for lodging and resorts, given the results on 2024. The hotel industry growing quite fast. Some industrial companies as well, providing very interesting metrics in terms of vacancy rates, in terms of rental growth. So generally speaking, most of the sectors were quite positive, but the main sectors showing a highlighting results were basically industrial, residential, and lodging and resorts. So that was the end of 2024 with quite a positive mood, recovering, and most of the companies very prudent but optimistic, basically looking ahead of 2025 guidance. So now we have the results season for Q1. So basically now the companies are starting to release the results for the first 3 months of the year. Of course, some quarterly results in the UK that most of the companies have a different fiscal year end. But generally speaking, what we can see from the results that have been released so far, around 30 companies we track until now, it's basically that the companies until now have been very prudent in their results. Basically, when they have been releasing the results for the first quarter, they are very aligned with the guidance for the year. Most of them have not changed at all the guidance, basically because it's too early to do it and is not sure if they will have to do it. So until now, the tariffs discussion, we will discuss a little bit more deeply into that point. But generally speaking, the tariffs is a lot of uncertainty and has no direct impact on most of the real estate companies. Basically, the impact is indirect through the tenants or through the economic variables that at the end could affect the listed real estate industry. So until now, most of the companies continue showing very strong operational metrics, positive rental growth, quite a limited level of leverage. The debt profile of the companies has been improving for several years now, and now it's paying off in terms of the cost of debt. We can also discuss a little bit more in detail the cost of debt and the debt profile. But until now, the mood it's very prudent, right? So most of the companies are still optimistic, are still positive, showing positive results, earnings, valuations so far, following the trend we saw at the end of 2024. And for now, just assessing the possible changes that could come from the tariff discussion and the uncertainty related with that. Until now, we have no clarity on what's going to happen with the tariffs decisions in the US. So of course, the companies have no crystal ball to forecast perfectly what's going to happen. But until now, everything seems to be under control and quite positive. So in terms of the big events that start having interesting impact in the listed real estate industry this year, it's important to highlight 2 of the main events. So the first one, Marek was already mentioning, is the German fiscal policy. So in March, when the German government announced this new fiscal program, where basically there was 500 million allocated to additional expenses, mostly related with infrastructure and housing and all the expenses that have an important boost for the economy. That was really good news for most of the markets. And of course, that implies higher expectations on economic growth, not only for Germany, but for the entire Eurozone. In general speaking, was good news, but that's more in the medium term. In the short term, what we saw was a very strong movement in the yields of the government bonds, starting with the German bonds and then all the government bonds in the Eurozone, basically because the new fiscal stimulus from the German government also implies higher debt. And actually, one of the changes was exactly to modify the debt constraints to allow more debt and expenses on the defense front. So because of that, the natural movement was increasing yields in the government bonds. Just a few days after the announcement, the German government bonds yields, the 10 years bonds, increased almost 35 basis points in just 3 days. That was a very strong movement, and of course that implies movements in the entire interest rate structure in euros, basically across the continent. So that was one of the main drivers affecting the performance of the listed real estate companies. This is a capital intensive industry, and of course interest rates, it's one of the main drivers for the business. So that had a negative impact on listed real estate when the announcement was released. Very few days with some negative returns, and mostly driving the performance of listed real estate as a result of higher yields in the bonds, and all the government bonds in the Eurozone. And then a few weeks later, we had the announcement of the tariffs, and it was something very volatile. As all of you know, there was a lot of volatility, but for real estate was an interesting movement. It was a trade-off between being a conservative sector, because there was no direct impact for the announcement. The announcement was basically on all the companies that had some commercial exposure directly exporting products to the US, but listed real estate has no direct impact. However, there is an indirect impact, the one that we were mentioning, through the tenants and also through the economic variables. So then when you have a possible risk of lower economic growth as a result of the tariffs, and also the retaliation from the other governments, then the returns start turning negative. So the first couple of days after the announcement of the tariffs were quite positive for listed real estate, and then they turn negative, and then they turn positive again when the US government start changing some of the measures, especially postponing the impact and the effective date for some of these tariffs announcements. So at the end, what we see was negative returns when the German government announced the fiscal stimulus. Few days later, positive returns as a result of the announcement on the tariffs, then turn negative and then turn positive, a lot of volatility. And in the end, what we see is that from the tariffs announcement, listed real estate outperformed all the equity sectors in Europe, having a total return of 5.7% as of Tuesday. And year to date, basically aligned with the general equity indexes, underperforming just by 60 basis points. And 1 year, it's a very similar story. So in general, the returns were very volatile as a result of these events that were very important in terms of the general performance in Europe. Another point that we wanted to highlight was the performance of home builders and developers. So the previous slide, this one, was mainly focused on listed real estate, and in this case, we were using the FTSE EPRA Developed Europe Index compared to the general equity index, the Stoxx 600. Here, this is a in-house research benchmark built by EPRA, aiming to track the performance of the home builders and developers in Europe. And what we saw, it was basically something similar, but even more important, the differences between the UK and the rest of the continent. So basically, the announcement from the German government was very positive for the continental home builders, especially those with focus on Germany. And then we saw a very strong performance in March for the home builders. And then the performance was quite positive for the UK home builders in April. So at the end of April, basically what we saw is the year-to-date performance turned positive, the one-year return for the general home builders turned positive as well. But what was interesting to highlight was the performance of the continental home builders that in the last year provided a total return of almost 22%. So in both cases, the German stimulus was very good news. Of course, they also suffer some volatility coming from the tariffs announcement, but generally speaking, the performance of the home builders and developers was quite positive as well. And finally, this is the last slide, just to open the discussion with Asha and Marek. Here we also like to highlight some of the reports we prepare or we sponsor at EPRA. So this time I wanted to bring these three to show some of the main key messages from the three reports. So the one on the left, the role of listed real estate for generalist investors. It's a very interesting report, basically showing some of the key points on how the generalist investors can approach listed real estate and incorporate listed real estate in the multi-asset portfolios. Basically, because there was still this way, traditional way of going very directional in terms of investing in listed real estate. So you see the economic cycle, you see the interest rates, and the traditional old-fashioned style of investing in listed real estate by generalist investors was you see interest rate decreasing, you invest in real estate, you see interest rate increasing, you sell. And basically was very directional, not very focused on long-term growth, on diversification, on risk metrics, just very directional. And in this report, the authors, Alex Moss and Yin Ku, they develop a very good analysis on the main points that have changed. So basically, now the listed real estate is much more diversified. You have exposure not only to traditional real estate sectors like industrial, office, retail, residential, also alternative sectors like data centers, self-storage, healthcare, student housing. So in terms of the sector has changed a lot. And also in terms of diversification and correlation with other equity asset classes, other asset classes, sorry, and also in terms of investment vehicles and strategies. Actually, in this report, something very interesting to see is how different approaches like completion strategies and also smart beta strategies can improve the performance of the portfolios for generalist investors. So highly recommended, very interesting report available on our website. Second one, it's from Maastricht University, also in March. And basically, it's looking at the social impact ambitions from the listed real estate companies. So in this specific case, the authors ran a very interesting survey for many landlords in Europe with an ESG approach. And basically, they were trying to identify how much of total return the landlords, the real estate companies, were eager to sacrifice for improving the conditions for the tenants. That's the main point. And basically, this is a very social-oriented analysis. It was an interesting survey with the very different angles in the assessment, and highly recommended as well. There was another webinar just for this report available on EPRA's website. Very interesting to see and very interesting conclusions. And finally, the report at the end It's Turning the Tide, listed real estate navigating today's interest rate cycle. And this is an in-house report that we run, basically trying to estimate the sensitivity of listed real estate to interest rates and determining the decreasing interest rate cycle, how much impacts the listed real estate performance. And of course, some of the movements that we have seen in the last quarters with interest rate cuts are included in that report, and we check the historical performance of listed real estate in Europe under the interest rate cuts cycles. That's an interesting report, and also very recommended for all of you to have a look. All right, so with all these comments, I think it's enough from my side, and we can start having a more dynamic discussion with Asha and Marek. Thank you.
Great stuff. Thanks so much, David. Yes. Yeah, very positive, obviously, end of 2024 with 50 companies that you track having an overall positive news results for 2024, and then only 8 below expectations. But as we say, it's still a bit too early to see what's going on in 2025. But with that in mind, and those slides that David presented, Sia, I think I'll sort of ask you the first question. But before I do ask that, I'll just remind the audience that we do have a chat function. And if you want to ask any questions, please do put them in there with your name, and we'll try to get back to you either today or after this webinar has finished at some point this week or next week. So yeah, going back to the discussion, I think I'll ask you first, Sia. What do you think are the main highlights from recent performances of the main real estate sectors that you've been tracking and dealing with in Europe so far? Do you have any inkling as to how 2025 is looking at the moment? Obviously, we don't have results, but you've probably got your ear to the ground and you've heard a few things. But what are the main highlights that you could sort of take and bring to the attention of our audience?
Well, thank you for the question first. Yeah, 2025 began with, I think it was sort of an uphill battle, I would say, for real estate. And actually, by February, the EPRA index was starting to catch up with the Euro Stoxx 50. However, as David mentioned in March, with you have the German defense budget, you have also the financial markets in general that were impacted by tariffs, and then you kind of had a big impact on the sector. In terms of the highlights, because one should think about real estate in segments and not as a big sector as a whole. You always have a pocket of profit. And I think one of them definitely is logistics. The macro environment was more challenging end of last year because there was a lot of questions on the softening of the demand, but also the expectation that the pre-letting on development pipeline was going to gradually improve, and we didn't see that happening end of last year. But beginning of this year, we kind of ask the same questions, and we are also hunting for some hints at every big player reporting in the sector.
Sia, I'm just going to stop you there. Sorry.
Yeah,
there's a slight problem with your audio. So I think a lot of us are hearing a sort of high-pitched frequency. I don't know if there's anything you can do to adjust your microphone, or is there...
I think I can bring my headset.
Okay. Yeah. Shall we we'll throw over to David to just give his thoughts.
I'll be right back.
Yeah, thank you. Yeah, sorry about that, everyone. Slight technical hitch with Sia's audio. We do test these things beforehand. It was absolutely fine before we started. David, I don't know if there's anything you want to pick up there on what Sia said, or going back to my original question, if there's any idea that you have there at EPRA as to how 2025 is looking so far? I know we don't have any official figures to show anybody at the moment, but any thoughts there?
Sure, sure. In terms of sectors, I would say some of the interesting changes in the last few months have been more appetite from international investors into those sectors that have deep discounts to NAV in the previous quarters. And some of the sectors that were under some kind of pressure from some of the drivers, mostly coming from the pandemic. So the most interesting cases in these two examples are basically retail and office, when we have many companies actually showing very strong results, very strong performance. The returns of the office specialists and retail specialists in Europe have been quite positive in the last few months, and definitely I think that's one of the drivers that is worth to highlight and to mention. I see Asha is back, so I will let her explain more in detail the performance of the sectors.
Hi, is it better like this? The
That sounds a
sound?
lot better
Yeah,
to
much
me.
better.
Apologies
Yeah,
to
much
everybody.
better? Okay,
Yeah,
great.
thank you.
Sorry about that. So I was just explaining on logistics. So beginning of this year, obviously, everybody was like kind of looking at any hints from the big player on the sector to see if there is like any takeoff on the demand, and especially on the pre-letting. I mean, you guys saw the last few weeks and also today some players reporting, and the interest was definitely there. So I would say the story needs to be continued, because is it structural, is it cyclical? I think it's more cyclical rather than a structural problem with the demand. Obviously, we could see some impacts, but we can touch upon that later on with the tariff, maybe if we want to discuss that point later on. And the second point that I wanted to highlight was on retail. So retail obviously had a tremendous 2024, and you would think that the rally is over or anything, but no. As David also showed it, they are kind of really still thriving, and despite also all the performance, the sector remains still quite cheap on implied yield. Sorry for that. And maybe just one point also to highlight is on offices. So offices is for many years now the segment that has been really disregarded because of, well, COVID, flexi job, etc. And we have seen a lot of different trends starting in that sector, and more we see that it's not working. So we really have like a strong demand for high quality building, high quality desks, and also answering all the grade A requirements. So for example, we had yesterday an announcement from HSBC looking for new offices because they have a shortage of 7,000 desks. So, I mean, I think we are gradually coming back to having really a strong demand there. And it's not for all offices, it's for really, I'm talking about prime offices, because you really have a polarized market, and that trend is accelerating even more here during Q1 2025. And also, it's, I think, one of the most discounted sectors. So it's about 30-40%. So it remains really, really attractive. And I would say, yeah, probably disregarded for the moment, as retail was a couple of years ago.
Yes, absolutely. Well, by the way, that 7,000 shortage of desks HSBC, is that in London, ASEA, or is that?
Yeah, exactly. So
yeah,
they
right.
did a move out from Canary Wharf, and there was like a news yesterday saying that in their new building, after being like installed and after moving in, they have a shortage of 7,000 desks. So it's
Wow.
quite a lot. Yeah.
Yes. Yeah. On Asia's point about retail, David, do you expect retail to have a good 2025, or is it too early to say in your view?
Do you want to go first, Sasha?
You can go, please do.
Okay, all right. So in terms of retail, well, what we have seen is a very strong appetite, definitely for both high street and shopping malls, but especially there is kind of this tariffs has brought a type of anti-American feeling where many consumers are going for a more local produced type of products, and then some of the sellers that are focused on local products are doing tremendous performance. And in terms of the performance for the tenants are doing very strong results, and the companies in the retail sector have increased their guidance from 2024 to 2025 tremendously. There is a lot of appetite for retail space, and basically it's aligned with the fiscal stimulus in Germany, basically having the largest economy in the continent, growing again, because basically the last 3 or 4 years were almost zero growth in Germany, and even a small recession, couple of small recessions. Then you have a very strong guidance and forecast in terms of economic growth for the coming years. Of course, there is always what happens if the tariffs discussion again becomes much more challenging, and also in terms of the inflation. So one of the issues that we have now, it's okay, let's see if the tariffs discussion goes further, and there's further impact in the European economy. And one of the variables that is under high uncertainty is exactly the inflation. If you have tariffs and on both sides of the Atlantic, then the natural result is that most of the imported products are going to be more expensive, and some of the inputs for some of the products that we produce locally are also going to be more expensive, and then you have higher inflation. And what you see is some of the central banks become much more prudent now. Today we have the announcement in the UK of cutting interest rates, but providing guidance of no further cuts until there's a kind of more certainty in terms of the future of the inflation. It's too early to say if the inflation is going to continue under control or is going to be affected by the tariff discussion. And exactly the same happens with some of the sectors that are directly related to inflation. So retail is exactly one of the sectors where inflation really plays a very important role in terms of the leasing contracts and the reversion, but also in terms of the tenants and the performance of the tenants in the retail space. So in general, the conclusion is that basically the expectation is still quite positive. The forecast in terms of growth, it's very important coming from the fiscal stimulus in Germany, but there is still a lot of uncertainty related with the US tariffs discussion.
If I can add just, I mean, inflation was literally one of the main driver for the rental growth in the retail space. And as you mentioned, David, with the tariff, I mean, we don't know where it is going. So, I mean, in 6 months, it could be like a total other landscape that we have today. But if we look back, like, for example, in 2024, the rental growth for the retail segment was really was like, thanks to the inflation, was thriving, and also help from the government, helping also some operators to still perform, into shopping malls, for example, and survive. So even if you have kind of those zombies, as we call them, because they are surviving thanks to government stimulus, they are a tremendous like opportunity into the retail sector. And having that rally in 2024 and still today. I mean, if you look year to date, some of the biggest players are still performing like close to plus 20% for some of them. One would argue, okay, is it maybe the time to back off a bit because of Earth uncertainties and also the economic uncertainty? I mean, it's still, if you look at multiples, it's still cheap.
Great. Okay. We'll stay on sectors just for now. We've had another question about tariffs, which is good because that's the next main question we're going to go on to. But this question is about logistics, warehouses and logistics. And somebody has asked, how do you see the supply situation in the UK as well as European warehousing and logistics? Are we in an oversupplied situation, or is this a bit of normalization? And could we expect slower development over the next 3 to 5 years? So are we oversupplied in the logistics? Some people would argue we are in some markets, right? I don't know who wants to pick that one up
I can
first.
start
Asiya?
maybe.
Yeah.
Yeah, I can start on this one probably. And David, please jump in if you want to add something or I don't know, have another point of view. We are here to discuss. So anyway, I'm open for it. One should understand that the COVID period was a special period. So you had big demand and it was impressive and never seen before. And I think all the logistic player, were trying to catch up on that demand. And so 2021, 22, 23, so it was like really outstanding demand. It's not normal demand. And the problem is, as it was not for 1 quarter or 2 quarters, but it was for several years, investors, or I would say the vast majority, thought that it would remain like that. And it's not the case because it's not a normal situation. So starting from H2 2024, we saw a normalization of the demand. So it's normal to take more time to have tenants for warehousing. It was not normal during 3 years having a lot of tenants queuing in front of your warehouse. That's not the normal situation. It's obviously great for the logistic player and also for the ones who are invested in logistic listed real estate. But this was not normal. It was an exceptional situation. So we are now going gradually to a normal situation. And that means being smart about acquisition, doing probably joint ventures, scouting the market for opportunities, and having also in mind, as I was mentioning for offices, but it's also the same for warehouses, having best quality warehousing. So for example, if you see some of the warehouse today, for some companies, they are really well developed and you have AI intervening. And those, I mean, the logistic players should put that in front for the tenants to attract more interest. And you can see also some players doing so today. And as much as, for example, like with the office segment where we're trying to put forward the best buildings, etc., to attract more tenants, warehouse, I think, should also do that going forward in order to attract more tenants. Because, like I said, we are going to a normalization, of the demand, and they will need to put more effort to attract more tenants and long-term and high-quality tenants. And also bear in mind, I think because someone was mentioning tariffs, for me, from my point of view, I think logistic could be. I don't have a crystal ball, but could be one of the segment that could be impacted by tariffs if they are imposed and if they are high. And one could argue that the economical slowdown would impact first logistic players.
Okay, thanks, Asiya. Let's move on to the tariffs then. I mean, both of you already mentioned them.
Just a second. I want to.
Sorry, yes, go on, David. Yeah.
Yeah, I wanted to expand one of the comments from Asha. Very interesting
Yes.
indeed.
Good.
In terms of the logistics, something that we have seen is also a more mature sector, right? So as Sasha was mentioning, when we have the pandemic, basically many of the logistic landlords, they had to rush and find more space because there was a huge demand and there was a lot of bottlenecks that have to be fixed. And now what we see is, okay, markets coming to normality, a more mature market, and then in the supply chain, more changes in terms of the type of properties you require. So at the beginning, it was very large warehouses, more than 10,000 square meters, where you were actually storing all the products that you were going to distribute. Doesn't matter the way, because the point was not efficiency, it was quantity. It was basically do it because it's the only way to do it. And now what we see is, okay, now that the markets are coming back to kind of normality, the growth continue, but continues in different stages. So now you have more demand for last mile distribution as well, and not all the big boxes, but also intermediate and small, basically improving the parts of the supply chain that at the end is part of the entire distribution process and the e-commerce growth. So generally speaking, I don't see either an oversupply of logistic properties. Is basically a change in terms of the type of property the supply chain requires, and the landlords are recognizing and also adapting to that. So the companies have also different geographies, different cities in the UK that they have identified as the best type of properties, depending of the type of strategy they follow. It's not the same approach for a company more focused on last mile properties than the ones focused on the big boxes. So at the end, it's a professionalization of the sector that improves the type of property that is required, and also changes the demand of type of properties.
Yeah, no, thanks, David. That's quite reassuring for people with exposure to logistics REITs and what have you. Excellent. Okay, so yeah, so let's move on to the tariff question. Maybe look at it a little bit in a little bit more detail, because we've had two questions on it from the audience. So the first question is, does the panel believe that in Europe the tariffs are more likely to result in inflation as opposed to recession? You've already mentioned sort of the inflation, haven't you, David? And the second question is, what is the impact of tariffs on values? I'm concerned as tariffs will impact viability of current projects and planned projects. So, which one should we tackle first? More likely to result in inflation or recession? Do you want to maybe look at that one? That's quite a macroeconomic question, but Asia, what do you think? Have you got a view on that?
Yeah, well, I'm not economist, so I will try my best here. I think from what I believe and what we saw also in the past is that we are in a globalized market. So we need some components for production that comes from basically everywhere in the world at a certain price. So if all of a sudden we don't have that, or we have an impact on pricing, part of the production of an end product here in Europe, then yes, inflation will happen again. And that's not such a bad thing for retail segment again, but also one could argue to what extent they could pass on the inflation, because they already did for several years after COVID. So, I mean, is it still possible to do that again? I don't know. On, I would say, more industrial impact, so warehousing, I think that could be potentially bad. Why? Because it could impact the frequency or the amount or the volume, I would say, of trades between, for example, the USA and Europe. And then less sales, so less demand in space, and probably also some project that could end up being delayed or cancelled. So less space rent. So that could be detrimental, I think, for a segment like logistics. I don't know what you think, David, if you agree or disagree.
Yes, yes, of course, it's a very interesting discussion, and I would say it's not an easy question in the sense that it's not a general rule that is going to affect all the markets in the same way. And what I mean is, it depends on the structure of each economy and each country in Europe. So, for instance, Germany, it's mainly focused on sports. So, if you are importing a lot, you are going to suffer from tariffs. But if you're exporting a lot, it's a completely different story. And that's the case for Germany. So, the largest economy in Europe is highly focused on exports. And then the question is how they are going to change the market if the tariffs at the end become real and you don't have a lot of demand from the American consumers, and then you need to refocus your exports into other markets. So then that is a question of not so much inflation, but economic growth. Some other countries like France, Spain, the UK, Italy have a more balanced trade with the US. And then the risk of inflation is a bit higher. But again, it depends of how much of imports are part of your economic model. And then there is no single answer. So in the UK, for instance, the trade between the UK and the US is much more larger than the one from Italy and Spain with the US. So there is a slightly higher risk of inflation in the UK than in Italy or Spain. But again, it depends of how strong the tariffs will impact the imports and exports from the US. So in terms of economic growth and inflation, a lot of uncertainty, but the good news is it's still the fiscal stimulus in Germany. I think that's one of the most important drivers that we can highlight entirely, because Germany was the engine that was off for several years. And now it's starting to roll in again, and that's good news for everyone in Europe. That's good news because that's economic growth, and economic growth means business. And business implies better tenants, and better tenants implies better landlords. So real estate at the end is going to be beneficiated. So in terms of inflation, a lot of uncertainty. The central banks are very prudent now. They made some interest rate cuts. Today was one, and a few weeks ago the ECB. But then the message is, okay, let's wait and see, because there is no clarity until now of what is going to happen with inflation. So that's the risk. The inflation is actually one of these variables that has different types of impact in the economy, and real estate is very sensitive. It acts as inflation hedging. Real estate, it's a very good investment for hedging inflation, but at the end, if the inflation ends affecting the economic growth, there's no hedging in any sector for that type of situation. So we'll see. It's still too early to say.
Yes. Okay. No, that makes a lot of sense. Thanks, both. And what about the second question about the audience members' concern that tariffs will impact current projects and planned projects? Is there, I suppose that ties into what you've both been saying already, but any fears about that at all at the moment, or is it too early to say?
If I can add to what I said, if I look to the major player in Europe, I think they are, if I recall correctly, practically the vast majority is exposed to Europe. So I would say in terms of having really a big impact, it would be marginal. So I don't expect it to be really impactful for the sector as a whole. If we see the big players, and you all know them, they are either exposed to Western Europe or Eastern Europe, and I don't expect it to be to have like really a big impact. Some of them are exposed to some US players, true, and it could have an impact, yes, but it remains marginal in my view.
David, anything to add your end?
No, yes, I agree with Asha. Basically, most of the companies that they provide a strong guidance at the beginning of the year, showing that they were expecting the economic growth to be positive, and they already start preparing the financing for the projects and finding the right properties to acquire or to develop. That's still going, because basically the certainty, as Asha was mentioning, is basically you have exposure to European tenants. The problem is more international, is we as focus, the tariffs is basically more related to the companies that have direct exposure to the US market. And that's a very limited part of the tenants in the listed real estate industry. So at the end, the uncertainty is still there, but the impact in terms of the proportion of the companies that have some type of direct exposure to the US is limited, and then companies can continue with the projects. Of course, there's always different types of hedging the risk. So some companies see some risk in terms of the interest rates, some risks in terms of the currency, sometimes in terms of the construction materials for new developments. And then many companies start looking at the hedging instruments, basically try to make sure that the projects are going to develop in a very natural way and following the guidance they provide at the beginning. So the business continues.
Excellent. Okay, so yeah, should we talk a little bit about the cost of debt and earnings? I think you sort of touched on this a bit earlier, and we've also mentioned the interest rate movements. I think Bank of England today with some their announcement, obviously. So my question to both of you is, what is your view on how the way this cycle is affecting the cost of debt and earnings for most property companies in Europe? What's your view there?
If you want, I can take first here.
Yeah, go for it.
This is a very interesting discussion, because basically many people, when the interest rate hiking start in 2022, many people and many investors were concerned about higher interest rates affecting listed real estate. And one of the points that we were always trying to make was basically the interest rates are going to affect the cost of debt, but gradually, it's not immediately. Why? Because you have debt that was issued long time ago, very low interest rates, and the process of renewing the debt and replacing, rolling over the debt when the bonds and the loans are maturing, is the process that is going to show impact of the interest rates, higher interest rates in terms of the cost of the debt. So at the end, the cost of debt has been increasing, that's for sure. Since 2021 until now, the cost of debt has increased almost 120 basis points. So it's a process, it's step by step. In 3 years, a bit more of 3 years, you have 120 basis points in 3 years. So it's a very smooth process. And what we also see is that basically the debt that is going to mature this year, it's in average, the coupons of the debt, it's around 2%, 2.2%. And next year, it's around 3.1%. So when you see the interest rates at the current level now, that most of the companies are issuing bonds for around 3.5 to 4%, basically you still have a difference between the marginal cost of debt and the historical cost of debt that is around 100 basis points. But the good news is that the central banks have cut interest rates in the last few months again. So the cost of debt, the marginal, is going to continue decreasing slowly, and the total cost of debt for the companies is going to increase slightly. And we see basically that 2026 is the year where basically they are going to be equal. So if you have the debt that is maturing exactly at the same cost that the one that you are going to roll over, at the end, the new debt replaces the old debt basically at the same cost. And then the cost of debt is going to be stable. So that's what we are expecting for 2026. And it depends of the central banks. So if the central banks keep the interest rates as they are now, this process is going to continue. Basically, it's what we were expecting. If there is an inflation suddenly rising again, and the central banks have to hike the interest rates again, then it's a completely different story. But until now, that's not the situation. The situation is central banks cutting interest rates, or perhaps not cutting more. Just they just stop now. That would be a possible scenario. And at the end, the rollover of the debt basically matching the old with the new debt. And at the end of 2026, basically we have a standard, well, stable cost of debt for most of the listed real estate companies.
Thanks, David. Yeah, just a reminder to everybody, we're almost at the end, but if you have any more questions, do post them for us. Asia, any extra thoughts on additional thoughts to what David has mentioned there?
Yeah. I just wanted to say that, well, obviously, as he said, it's quite hard to really foresee any scenario because it depends on so many variables. But just on top of cost of debt, because you were mentioning as well property valuation. Property valuation is depending on long-term rates, and for the moment they are quite high, and it's not really benefiting when you are discounting your valuation for your property today. Well, it's helping on ERVs, but not really for the valuation itself. So yes, Fed and ECB are doing their best to kind of gradually decrease the interest rate. So you have like a short-term pocket that is helping for the cost of debt. It's increasing, but it's gradually, and like David said, I think it should be okay with, I think, most of the refinancing happening in 2026. But on the long term, I think that's where the real question mark is for the real estate sector as a whole, because we had a positive signal just before Trump announcement on tariffs. They were kind of gradually coming down, and it was helping the real estate sector. And then it hiked again quite aggressively with the tariff announcement, end of March, beginning of April, and we are still quite high, I would say. But yeah, I just wanted to point that out.
Excellent. Yeah, no, thanks, Asia. Yeah, we've got 2 minutes left. I'll give you both the final words, perhaps on investor sentiment. It's a shame we've run out so quickly of time, but there we go. That's how these things go. But just a quick note for everybody: the next webinar on the listed market hosted by EPRA and Institutional Real Estate Incorporated will be in October, and we'll be sending out reminders. So look out for that in the autumn, in the fall, in October. Yeah, so to end, maybe David and Asia, if you have a couple of sentences maybe on investor sentiment. How are investors that you're speaking to, how do they feel at the moment? Are they positive? Are they worried? What's the sentiment out there?
I'll start with that one. So I think we can say safely that there is a big shift into the focus on real estate, where probably 2-3 years ago there was like a lot of worry on the whole sector, and as we saw all having a negative impact on it. We, I think, bottomed up in 2024 in terms of also property valuation, and also on the sector in the different segments. 2025, I think, is the year where we could see a shift into the sector, mainly like retail, logistics, but also healthcare. We didn't touch upon that segment, but it's one of the most exciting in the beginning of this year. And as you all know, there is like currently some deal ongoing. And I think it remains a tremendous sector with a lot of key drivers and potential for growth in the coming quarters. And after having several years of difficulties, I think it's really the time to look into it and to do, I think, proper work to really look into the profits in different segments. Because like I said, people think wrongly, okay, real estate sector, who wants to be involved in that following the rates movements? But I think it's more complicated than just, a switch on, switch off, like you were saying, David, on the sector, depending on what bonds are interest rates and also the whole sector is doing. It's more complicated than that, and it's more you always have insight to remain invested into real estate, depending on each segment, but stay involved and stay invested in real estate.
Excellent.
And I think
Thank
the
you.
message is gone now through to the main investor communities, because we see them coming back a lot.
Yes, yeah, very true. Yeah. David, final word to you.
Yes, I would say current cycle matters, but long-term trends matter more. So we have mega trends that are there and are going to continue. Demographics, aging population, digitalization, and increasing a number of students. So basically, these long trends are going to continue, and the listed real estate companies are very well positioned to take advantage of these mega trends. So long term, this is a long-term industry, and the long-term trends are aligned with the long-term projects and guidance for the real estate companies. So that's a very important approach that most of the investors have, and that's very good news for the sector.
Excellent. Well, ending on a positive note from you both, which is great. Once again, thank you, Asia. Thank you, David, for your time, and thank you everyone for taking part and for listening and asking questions. And we hope to see many of you back in October for the second one this year. But for now, thank you, everybody.